Now that we've built a solid foundation, I'm going to introduce to you a time frame that has been massively underrated and very misunderstood. This is the 4-hour time frame. Usually, you would think of the 4-hour time frame as maybe more directional, not really in execution. But there are ways in which you can effectively execute on the 4-hour time frame, but it's just knowing the different scenarios of when to use it. Now, we're going to maximize that today. But what I want you to remember is at the end of this, I'm going to give you exercises. I'm going to give you exercises that you can walk away with and start to see the impact on maybe trades that you've even taken previously and how the 4-hour could have helped in a really big way. Now, this is going to be in 2 parts. Part 1 is going to be the core concepts I'm about to teach you. Part 2, that's in AFT. That will come at a later stage. You don't want to run before you can walk. You want to master the basics first. Traders have a tendency to try to run before they can walk, and then they wonder why there's missing gaps within their performance. We're going to fill those gaps. We're going to build a rock solid core. Just like if you went to the gym, you wouldn't go into the gym doing all the fancy intricate little details without having your core concepts. You wouldn't do all of these fancy machines without doing squats, without doing pull-ups, without doing bench press, without having the core things in place. Building bad habits, bad form, you want to make sure that the core is really dialed in, and we're going to do that. And then at a later stage, yes, you can do all the intricate little things, you can maximize on risk to reward, but this alone, just by utilizing the 4-hour in the appropriate way, is going to be an absolute game changer, and I'm looking forward to sharing the benefits with you now. So I'm going to list out 8 points for you. I want you to write them down, and I want you to think about these points as I elaborate in more detail in the chart work. I want you to think about, what is he talking about when he's going through the chart work, which part relates to that, and why is he talking about it? I want your concentration and focus, because this is how you're really going to apply it, but truly understand how important it really is. So number 1, you have increased win rate. Number 2, hold in trades for longer, increasing your patience. Number 3, reducing your overtrading. You'll naturally reduce your overtrading because you'll be waiting. You'll have more discipline to wait for this as an executional time frame, and it will avoid a lot of hindsight losses that you don't really need to take. Extra entry opportunities. Naturally, this is normally a directional time frame, but now you can see it as an entry time frame. You have extra opportunities, which will probably increase the frequency of trades. Usually, when you think about lower time frames, you normally associate that with, I'll take more trades. You wouldn't associate it with a higher time frame, but this is a very special time frame, and you'll see why that adds the extra trades. Prep work becomes easier because now you have a longer duration to wait. You're not just jumping in every 5 minutes. Going full time, easier, dare I say it. Going full time naturally, because you're going to avoid a lot of losses, and you'll probably find that, yes, maybe you don't make the biggest return, but it's not about the biggest return. It's about making sure traders are not undercapitalized. It's about having a bigger account and making sure that you're making returns on that. So this is going to fit in nicely with that. The 7th point, risk of ruin. What do I mean by that? Survivability. Think about it from that perspective. If you're someone who's just jumping to the lower time frames, you're learning a new system, and you're just taking a whole bunch of losses, you're more likely to give up. You're more likely to jump to a different system. So your risk of ruin is less because you have to wait longer. You essentially survive in the game long enough to be able to fix your mistakes and become profitable by dealing with these higher time frames, but in the right way. The last point, the 8th point, is building the habit of being in winning trades. Now, I've said this since the very beginning of this project in 2017. I would much rather you have a wider stop loss, build the habit of being in winning trades so you actually have the experience. If you have a really wide stop loss that's not relevant, we can refine that at a later stage. We can't refine if you're not in the trade itself because you've been too greedy. The 4-hour is going to help with that massively, and you'll see why. So these are the key points, and I'm going to go into much more detail throughout the chart work. Right guys, so before we get into the chart work, I want to run you through some examples, when to use it, when not to use it, what the structures are going to be looking like, and of course the candle shapes throughout. So first and foremost, what do we have? We have our hover consolidation. This is your unstructured. You would already be utilizing this on the lower time frame anyway. So this would be you going to the 1-hour time frame. You wouldn't be using the 4-hour because it's probably going to close 50% of its range. And at that point, you're actually getting a less refined entry by using the 4-hour on those squeezed consolidations. What you want to focus on is these. Now notice how there's more green than red. And the beauty of that is the time frame itself, because a lot of the time there would be more intricate justifications as to what you need to do. But because you're dealing with a higher time frame, essentially it washes out a lot of the noise, and then you have that extra confirmation. So your typical two-touch, think about it like this. Your typical two-touch, if I showed you that on the 1 hour, what would you be thinking? Well, how do I take that? There would be loads of prerequisites before that. I'd be looking for an insurance entry. Of course, that would be a given. Now, still, there's going to be a time and place to do that. I'm not saying now strictly focus on the 4 hour and never take a 1 hour entry, but this is more of your larger structures. So with the two-touch continuations, they're already going to have that 4 hour confirmation. What's the beauty of this? Well, you're going to be in situations in which the lower time frame doesn't give you your insurance entry that you're looking for. So then you just have your 4 hour entry. Beautiful stuff. Then you have your V-shapes. These V-shape recoveries are a little bit trickier to take when you don't have a higher time frame in mind. So let's say, for example, this is a 15-minute hook, because both of these side by side, you're going to have more of a sharper hook, or you're going to have a flat, small consolidation that price recovers to. If this is on the 15-minute time frame, price recovers fast, it rejects on the 15-minute, that could be part of a completely different structure. And then what you end up doing is chasing the trade, you take unnecessary losses. This is where, by default, what do you do with these V-shapes? You wait for your insurance entry. What helps in these scenarios is if you have a 4 hour retracement, and that could be a 4 hour heavy body, it could be a pin bar, it could be a tweezer top, or just a retracement in that area. All of these candle shapes, bar the long-legged doji, they're all applicable for every single entry type. So then you're going to have that situation where you can validate the trade, and then let's say an insurance entry comes, great. If not, you're still working with your 4 hours. So that's going to be your extra entries that you wouldn't originally get. Do you know what the other benefit is? If you're trading a pair like a Aussie CAD or a Kiwi CAD, etc., sometimes you get a lot of consolidations, or the sequence doesn't move as well because it's naturally a corrective pair. But then the 4 hours still in place. So you benefit from the structure, and then you don't have to wait for this perfect lower time frame entry, therefore increasing entry types. Your typical 3-touch flat continuation, I mean, that's self-explanatory. All of the validated candle shape criteria, you just take that at the top of the structure. Then you've got your steeper decline. Naturally, the flatter the correction, the better it's going to be, but there's going to be a time and place in terms of, if you're taking a 3-touch continuation and it's steeper, what I've already taught you in the sense of, if you have a consolidation above and it intersects with it and you're wondering, right, is that more valuable? Yes. Everything that you've learned is the same thing. We're just dealing with a higher time frame. But what I will say is this, whether it's a steeper incline or an expansion, if you can't see it and you're on, because you're looking at the 4 hour, if you can't see a consolidation above, you don't need to put as much emphasis on it. The same way, if you had a 1 hour continuation that was flat, you wouldn't then go and search for the 5 minute and worry about it and then not take that trade. You would just be aware of it. It's the exact same thing. And then, of course, all of these in reverse, if you have this as a bullish continuation, you deal with it in the exact same way. These are the kind of candles that I want you to stay away from, those long-legged dojis, because they're just going to give you a lot of noise, a lot of mess. You do the simple thing, wait for the insurance entry. So these are the concepts I want you to apply when you're dealing with the 4 hour time frame. So now you understand the importance of these candle shapes. Let me show you what they look like on a losing trade. So we're going to focus mainly on the losing positions here, so you don't get caught into trades that almost look good, but you miss the finer details. So we're going to focus here on Aussie dollar. So we have our continuation play. So let's mark it up. So let's say, for example, we're looking at an expansion of price. You've got your expansion here. There are a few things that you need to consider. At the time of entry, you're going to be looking at your first entry. And let's see if this is something that meets the criteria. So let's play this back. So you have your entry right here. So here you have your 1, your 2, your expansion, your rejection. Probably looks quite good, right? Why should we not take this? What doesn't meet the criteria straight away? We have a rejection. I mean, the rejection in and of itself is okay, but not in relation to the candle. So what we've got here is measuring this candle. Does that hit 50%? No, nowhere near it. Even at the body, doesn't hit 50%. So you've got a rejection that hasn't fully rejected, and it's going to get you caught up into the trades. Therefore, you would set your entry like this with your stop above, and then you would have this tag you out for a 1% loss. There you go. That's something you should have avoided just by measuring it with the fib tool. That's done and dusted. You know what to avoid now. Then we look at the next trade. The next trade is actually your 1, your 2, your 3. You've had that retrace. Again, you don't need to jump in too early. You've had your bullish high test. Is there a potential for a wick fill there? But you've got to look left and think, right, if I've got some rejections in these areas, I can position myself much better if I have my stop above that wick. That's essentially your washout if you think about it, and then you've got nothing to the left to worry about, and you're dealing with a 4-hour structure. Now you might be worried about, well, you've got a correction into a correction. This is where you have to put less emphasis on sequence, because if you had a 15-minute structure that was a consolidation into a consolidation, why do you need to worry about that more? You need to worry about it more because it can tag you in, tag you out, and just be part of this. Where when you've got a larger structure like that, it's usually going to commit to its individual structure. What would make it better? The only thing that would make it better if it was in a simple impulse correction versus correction to correction. That's it. But you got to remember, you're dealing with a 4-hour time frame. So as a more weighted intraday time frame, it's already washed out a lot of the noise anyway. So if you look at the next trade, this is a trade I'll be happy to take. You've got that rejection there. So this is after this green candle, that first red candle, that little high test. Perfect. Why? Because what that does is it gives me the opportunity to enter like so. And I would have my stop just above the wick, which puts it about 16, call it 17 pips. That's my entry. And then I'm looking for my target down here. Now, what you're naturally going to find is sometimes your risk to reward is exactly the same as you take it on the 1 hour. Sometimes your risk to reward is going to be less because of the size of the rejection that's still relevant to the trade. So you might be dealing with, let's say, a 3-to-1. I'm just going to plant that right now and we'll get into it later, but 3-to-1 is your now minimum criteria if you're playing a 4-hour. You naturally have to compromise your risk to reward ever so slightly, and 3% is your minimum that you should be focusing on. But let's say we take this trade. So we're tagged in. Let's have a look at how it plays out. Starts to do okay. You could argue that you might be able to get to break even, but in that scenario, that's not going to be the case. Technically, where do we get to? We get to roughly 1%, or, we pretty much get to 1%, but it's one of those ones that you're dealing with a 4-hour structure. You're naturally going to be more lenient with a trade. In a random scenario, someone might take a break even, but this is not this. This is a good loss. This is a loss that you should take. What do you think is the issue within here? It's not just the trade that you shouldn't have taken. It's the trade that was already present within the structure. So let's look at it in real time again, and then you'll see. So if I remove all of that, what would it look like in actuality? You would previously have this, and this is the importance and the benefit of these trades, that if I show you a trade that's on the 15-minute, you're going to have to rely on you being there in the time zone in the perfect world. But when you're dealing with the 4-hour, it gives you more of that flexibility that I spoke about. So in the prep work, it's way more straightforward. Really, this is your simple flat 2-touch. You might be wondering, what about the size of it? Again, you have to put less importance on sequence purely because the 4-hour has mitigated a lot of the risk for you. So if we measure this candle, let's say you're looking, and I want to show you realistic examples versus these perfect scenarios that do exist, but they're a rarity. So if you look at your bullish candle and then you measure that, is that 50%? Yes. So it's 50% of the candle. So as soon as swaps have finished, this would be an overnight position. That's absolutely fine. You're trading with Aussie dollar, so that's normal to set that overnight. So you would set your entry and you'd be tagged in here, like so. You'll stop above. Now you can have this, call it roughly 16, 17 anyway. And then you would be targeting the low, which is 3.5. That meets the criteria. At peak, it's about 5%. Let's say you've done a trailed management, you'd probably get out about 3.5%, but it meets the criteria. Even if you had more of a mechanical side to it of a take profit area, that meets the criteria. So let's say you did just walk away with, worst case scenario, you had your 3-to-1. All of these trades are fine, bar the first one, just by using a simple measurement tool. Now, why am I going into detail on this? I'm going into detail is because at first glance, that rejection actually looks okay. This is where you look at the rejection, it's not 50%, and if it was 50%, let's actually look at that. This is really important. So if it was 50%, that would mean that your entry would be here. Your stop would be roughly above there, 36, and then look to that low, 1.4, and then to this low, 2.1. Doesn't meet the criteria, so it's a no trade anyway. But more so, that's where you let the insurance entry do its job, which is exactly what happened. So you shouldn't have taken that loss if you'd followed the strict rules, and it's really simple for you to do so. So then what have we got? Let's say, for example, someone's taken that loss and then they've taken this unnecessary loss. you're dealing with -2, and then you didn't take this trade. That's where the issue comes, where if you made your 3%, you avoided that loss that you shouldn't be taking. And it's not like it's difficult to avoid that loss. You just had to measure it and realize, right, that doesn't meet the criteria. I take an insurance entry in this scenario. Then you take this next trade, which is not perfect, but still a very good trade. You take your -1, you're still left with net 2% and maybe net 2.5 if you managed it a bit more, etc. So that in a nutshell is just a simple expansion. It's not your perfect sequence, but a very good representation of a trade that you were still able to capitalize on without being by the screen, set and forget, leave it overnight, and still able to capitalize on this trade.